Welcome to the year-end commentary. I'm Bob Baker, and joining me today is Phil Voelker, AAMA's Chief Investment Officer. Happy New Year, Phil.
Happy New Year to you.
Hard to believe we put another year under our belt, and we're starting on another year. But
There you go.
we are doing it. On the surface, 2025 seemed to be like an average year. But if we look under the surface of this, there's a lot of continued volatility and growing concentrations within the market. Phil, what do you think this means for the markets, our investors, our clients, and what do you think we can expect in 2026?
Yeah, well, the 2025 being sort of an average year, it is, if you look at the average large cap stock return of around 11, 12%, the cap weighted index was up, 18 roughly.
Mm-hmm.
And the last 6 years have been dominated by the 10 largest stocks. So, the market gains have been dominated by that group. Anywhere from 30 to 50% of market gains have come from just the 10 largest stocks. And today, we've got one stock that equals 7% of the S&P market cap, 3 that total 18%, and the top 10 are 35%, which is the highest number going back to the early 1930s, late 20s. So it continues to be a concentrated market, and that means that there's still elevated risk in the market. And if you look at some of the expectations for next year, the semiconductor sector earnings projections are for a 40% gain in earnings. Technology, 28%. And the S&P is at 17% projected earnings gain for next year. So the large companies have been carrying the market for 6 years, and they have some pretty lofty expectations to meet next year.
They're a continuation of what we've seen the last couple of years, obviously.
Right. And we did start to see some broadening out of the market in the last half of last year. But, if you look at overall PE ratios, the forward PE on the S&P is 22 right now. The Mag 7 is 29, but the other 493 is still at 20 times forward earnings. So it's not like they're totally at different extremes. The 493 of the S&P, 20% or 20 times projected earnings, that's still a pretty lofty PE ratio, no matter how you cut it.
It sure is. It's just surprising. Let's shift gears and talk about the economy for a minute. What are you thinking on the economy?
Well, we've last several years, a lot of economists have called for a recession. When the Fed started raising rates, there was a lot of recession calls. Again, in April, with the implementation of tariffs, there's a lot of calls for recession. We have been pretty steadfast on the other side of that position, not joining the calls for recession. Today, the economy continues to be strong. A couple of factors, we still have inflation to digest. The economy has managed through it so far, but with the K-shaped economy, it's not as broad-based as one would wish for as far as the strength of the economy. And There's the investment in infrastructure to support artificial intelligence. It's been running, 400 to 500 billion a year for the last couple of years, and that's projected to be 500 to 600 billion a year for the next 3 years. So that has been a big support for the economy.
A lot of inflows and investment. How do you think we're going to deal with a lot of the power needs that these data centers need? And the talk about how old the grid is, and do you think we'll really get anything built out and new?
Well, we will, but it takes time. I don't care what you say or what anybody says, you can't build a nuclear power plant in a year. You can cut the permitting time, the environmental impact statement times, but you can't get it done a year. So we're already seeing increased cost for electricity, and it's going to be a problem to support the data center demand. So, it's going to be an issue.
Yeah, and I think a lot of consumers are starting to see this on their own electricity bills, and the rate increases that are already being passed through are almost incredible.
Yeah, they definitely are.
Anything more on interest rates and the new potential federal or the new Fed chairman? It's not potential; there'll be a new one. Any opinions or insights on that?
Well, it's sort of interesting how we've had a year of financial media focus on this because the administration has been pushing for a significant change in, we'll say, not just leadership, but attitude at the Fed. And we've already seen the market push back, the bond market push back as the Fed has cut rates. Further easing from this point could be problematic for the bond market. If we look back when the Fed started cutting rates a year ago, September, with the 50 basis point cut, mortgage brokers were telling their clients, just wait, the Fed's going to cut rates. Well, from that day of that cut through the end of the year, mortgage rates were up 85 basis points, and the 10-year was up 100 basis points. So what has been happening is the yield curve has been steepening. Higher inflation has been gradually priced into the longer end of the market. And even with this last rate cut, the long market has not been responsive to that, meaning the 10-year is about unchanged from where it was when the Fed last cut rates. So the market's starting to push back over the last year and a half. And if you look at long-term real rates, pick an inflation number, call it 2.5 going forward. You have to add to that at least 200 basis points based upon history for a decent inflation premium. And so that puts you at 4.5 or 5, depending upon what numbers you want to pick. It's somewhere in that range. And that I don't think would be looked upon very favorably by the stock market to have another 50 basis points back up in rates. The interesting thing to me is that, Chair Powell has never really said a whole lot about his personal ideas. He always refers to the committee, but at the last press conference, he was asked a question, what do you want your legacy to be? And he said, well, I just want to be known for leaving the economy in good position. So there's only one thing he can do to support the building of his legacy, and that is to cut rates when maybe you don't even need to, or maybe you shouldn't. But going into his retirement, if you will, in May, he may be more dovish than he otherwise would be, which again translates into higher inflation premium, steeper yield curve, et cetera, out in the longer end of the curve. So it's sort of a contemporary factor that is sort of fun, I guess you have to say, because it's a person concerned about his legacy at this point.
Sure, and I think I was reading someplace that the average mortgage rate out there is about 4.25. So there's no reason for many people to even try to refinance at this point. And it's going to take a pretty good downswing in mortgage rates to get it low enough to incentivize or make sense for people to refinance. And then if you've got a 3% mortgage, I'm sure a lot of people are thinking, why would I want to sell this house, go into another house at 6%? So half the house at twice the rate. So it's really an interesting dilemma we're in right now.
Yeah, well, and that stratification of the outstanding rate on, or the rate on outstanding mortgages has really clogged up the housing market as far as resales go. And that average rate on the outstanding mortgage has started to creep up a little bit, which is only natural. I mean, you're going to have people selling because they have to move for work or whatever. It's going to gradually come up, but it's still extremely low, as you said.
Yeah. My first mortgage was back in 1982 at 16%. And I don't know how I afforded it back then, other than the fact that real estate taxes were so low compared to where they are today. And of course, rates fell pretty dramatically after the high in 82. But,
Well, plus housing prices were a lot cheaper then, too.
Sure. Absolutely. Absolutely. So, well, to close out, where do you see relative value today in the markets, in both equities and fixed income?
Well, the fixed income's pretty simple. We still see volatility in the longer end, so we're staying short. Quality spreads are very narrow, so it doesn't make a lot of sense to take credit risk. So we're short-term, high quality in our fixed income positioning. The equity market's much tougher. It's overvalued by any measure: price to earnings, price to book, price to sales. And every single sector is above median as far as its historical PE goes. So in these kind of situations, we like to turn towards lower volatility in sectors. So healthcare, for example, is a sector that has considerably lower price volatility and lower volatility of earnings. Within the technology sector, there's actually some stocks that are relatively cheaper, and the overlying theme should be quality. You look at the quality of the balance sheet of these companies that are investing these hundreds of billions of dollars in data centers. They're strong. So, the fact that we could have a bubble in data centers is true. I mean, it could be that there's big disappointments, but the companies that are doing the investing could afford to pull back, if you would, from that market. It would hurt their earnings for a while, but these companies are not going to go bankrupt because of it.
Right. At least they have a lot of cash on their balance sheets. So
they do, and their cash flow has been strong. Free cash flow is still positive, except for Oracle, which is now negative free cash flow because they're spending much more than their cash flow, so they're borrowing. There's some borrowing in some of the higher quality names too, just from a cash management standpoint. But again, these are strong companies, and it's a matter of a disappointment in AI, if there is one, then it's going to hurt earnings, not risk the solvency of these companies.
Sure. Well, as always, we appreciate your insights and taking time today to talk about our commentary and views on the market. And we'll say goodbye to everybody until the next commentary. Thank you.
Thank you.